Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and generate consistent returns year on year. So the first thing you need to do is open up your brokerage platform. The one I'm using is Tasty Trade. You can use whatever you like. And of course, we are going to be writing or selling options contracts. So we need to know where we are in the options cycle to begin with. So if we just pull up any underlying, we can just pull up, say, something like Apple here. We just want to see a list of expirations to start with. So we've got our weekly expirations with the orange W, and then everything else is a monthly expiration. We want to stick with the monthly expirations. So the next monthly expiration is October 18th, which is 15 days out in time. We want to be anywhere from 30 to 60 days out. 45 days would be ideal. So 15 days is too short for us. So we're going to go down to the next expiration at November 15th, which is 43 days out in time. And this is much more suitable for us. So now we can take this information. So we know we're going to be 43 days out in time. We can come over to our watch list. It can just be any watch list. And we basically want to filter out any underlying that has earnings over the next 43 days. And the reason for this is because earnings can have a negative effect on your P&L. It can mess up your deltas and almost certainly increase volatility. All of these things is not going to make for a fun time for you. So as well as doing that, we can remove any underlyings that have a low liquidity level. So what we're left with is everything here is very liquid and does not have earnings over the next 43 days. Finally, we just want to order everything from high IV rank to low IV rank. The reason for why we do this is simply because we want to sell when volatility is high and play the contraction back down to the mean and potentially even further below than the mean. So what we want to do at this point is we just want to go down the list and see what would suit our portfolio. We want to keep in mind what we've already got in our portfolio. We are running light on positions. UAL is requiring quite a lot in buying power. We have got a futures Australian dollar position on. SMH is a very small position. And I think we can look for one more position to put on, and we probably will be looking for a futures position in this portfolio. However, we're not going to be going over futures in this video. We are just going to look at standard equities. But the point of looking at the portfolio is that if you are heavy in any one thing, then you want to make sure that any new positions is keeping your overall portfolio nice and diverse. So we just want to go down the list. As you can see here, we've got crude oil futures with a lovely IV rank of 114. We've got Baidu with an IV rank of 105. JD, Baba. For anyone that's been following the recent videos, we did mock up a position on Baba. And as we can see here, volatility is starting to come out of the market. And this position would likely be in a little bit of a profit at this point if we had put that position on. So it's good to see that everything is working as it should. But we want to keep going. We wouldn't really want to be putting on a position on Baba at this point. I mean, you absolutely could. IV hasn't dropped too much. But we're not going to mock up a position on Baba because it's practically going to be the same as what was in the last video. So we're just going to keep it fresh and keep going. We want to stick with an IV rank of over 50. Anything over 50 is considered high. Anything below 50 is considered low. However, for example, Walmart with an IV rank of 42.3, trading at about $80. That's not a bad IV rank. And in fact, I think we're going to have a look at Walmart. For Walmart, 42 isn't too bad. As you can see here, earnings is on November 21st, which is just 6 days after the expiration of our contract. So as you can see, we've now opened up that expiration, and we can see the options chain here. And this orange horizontal bar shows you where price currently is with respect to the strikes. And this small vertical orange bar shows you the expected move of Walmart over the next 43 days. So what do we do now? We want to start selling contracts, but we need to know what are we going to sell and where are we going to sell it. Well, there's two types of contracts, calls and puts. We're going to sell one call and one put. Where are we going to sell it? Well, we want a high probability of profit. We want the odds to be in our favor, so we can use the expected move to engineer a high probability of success in conjunction with the delta column here. So I like to be anywhere between 15 and 20 deltas out. As you can see here, we've got a 14 delta. The next one is 24, which is a little bit high, so we will just go with the 14 delta. And then we have got an 18 delta on the put side, which is really nice. So as you can see here, we've we're essentially looking at selling two contracts, one call contract at the 87.5 strike and one put contract at the 75 strike. And when you stick with a 15 to 20 delta, what you'll notice is that more often than not, if not always, your contracts will be right on the edge of the expected move or even further out. And what that's going to do is that's going to give us a very high probability of profit. As you can see here, we've got a 69% chance of turning a profit on this trade, very high probability. And if we wanted to actually get out of this position at 50% of max profit, we've got a 90% chance of that happening. So very, very high probabilities. And if we were to just mock this up on the chart and see what that would look like, so we'd be making price levels at 87.5 and 75. So we've got 87.5 and 75, which is about there. Cool. So this is the range that we've created for ourselves. And what do we want to happen in this scenario? So we would want Walmart, or the price of Walmart, to be within this range at expiration, which is 43 days from now. And if that happens, then we keep 100% of the premium that we collect up front. So what is the premium that we collect up front? It's this. It's $1.09 multiplied by a contract multiplier of 100, because there's 100 shares in each options contract for equities. So that's going to give us $109 of premium that we collect up front. Our broker is going to require just under 1.1k in buying power to open this position, but we will be able to collect about $109 up front. So we're looking at about a 10% return on this position with a very high probability of profit. Now, I don't think there is any need to cover our shorts like we have done in some of our other videos. The position isn't that large. I mean, it's only, it only requires about $1,000 in buying power. By all means, you could just buy a contract a little bit further out to reduce your buying power requirement, it will reduce the premium you collect, it will reduce the probability of profit, but it massively reduces your buying power requirement and also makes it a much higher return on capital trade. However, in my opinion, I think that the naked position is just much cleaner for this underlying. And with that being said, there is also one other thing that you need to keep in mind with your positions, and it is your position sizing. It doesn't matter what you know. At the end of the day, if you're sizing your positions wrong, eventually it will end poorly for you. So we've got a free position sizing template that everybody can use. The way it works is you enter in the size of your portfolio. Let's say if it's $25,000. Below that, you will then enter in whatever the current VIX level is. Let's just say if it's 15. Everything below will then be automatically calculated for you. At this point, all you need to do is use this information to form the backbone of your portfolio. It will tell you how much buying power to allocate to any single defined risk position, any single undefined risk position, and how much of your portfolio you should allocate to short premium strategies in general. So follow the information here and you'll be fine. To get a copy of this, click the link in the description, click on the free position sizing template, and that will take you to where you need to go. If you do want to get involved on the positions that we're placing, and if you want to make money with us and basically copy our positions, again, click the link in the description, head on over to EDS Premium, get yourself signed up. Inside, you will have access to our portfolios where you can copy all of our positions and our adjustments, etc. There is a full course inside as well. So no prior knowledge is required. We will teach you everything you need to know, and this setup will allow you to learn and earn at the same time. It is a private community, so you can speak with myself and like-minded individuals, and there is also a 100% money-back guarantee. So if you've studied our full course and followed our trades for 6 months and haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. Right now it's £1 a month. The price will be increasing, but once you're in, you're in. You don't need to worry about price increases as long as you don't quit and then join back at a later date. So you are rewarded for getting in early. And with that being said, I will see you guys on the inside.